In order to change language, click on this button on desktop and laptop, go to audio track, and there will be more than 10 audio tracks that you can listen in. Click Hindi and आपके सामने हिंदी audio आ चुका है. Enjoy. In this video, I'm going to show you guys how I would start my swing trading career over again if I would have to start from the scratch. If I had this information back then, these tools, these platforms, a set roadmap, then I would not have wasted so much of my time. Here's how this video will flow. First, we will set the foundation. What swing trading actually is, how it is different from day trading. Then we will cover some essential tools and platforms like TradingView and brokerage platform where you will place your order. After that, I will break down some psychological points and risk management framework that keeps you in the game long enough to win. Finally, I will show you exactly how to build and test your first swing trading strategy and apply it step by step. Let us first understand what is the goal of trading. The simple goal of trading is that you bought something, let's say, at a price of 100, and then you sold that same thing after a period of time, let's say at 120. So you made a profit of 20 rupees. Let's say you sold something at 120 and you exited that trade at 100. So you again made a profit of 20. So there are two people that are involved here. One is a buyer and one is a seller. When you enter stock market, there are a lot of instruments that you can trade. There are a lot of type of trading that you can do. How to understand which type of trader you are? Okay, so there are three things actually you can do: investing, swing trading, day trading. Now, what is investing? Investing is let's say you put 1 lakh rupees of capital at this bottom. Okay, you purchased an entity. It could be an instrument, it could be a stock, anything. You purchased it with 1 lakh quantity. That means you had 1 lakh rupees and you put it there. Now you are sitting for a period of time. Now that period of time is around 200 days. Here it is written 189 days, right? So around 200 days you were sitting in that particular instrument, and then you made a total of 47% return. You guys can see, so 47% returns means on 1 lakh is equivalent to 47,000 rupees. So after a period of 189 days you exited it, and at this point you were having 1 lakh 47,000 rupees. Now what exactly is swing trading with respect to that? Now let's say that you have a set strategy, you have a setup, that you are putting 1 lakh capital in this first move of the market, the upside move of the market, right? And you made around 22% return in that. So that is around 22,000 rupees. And then you exited the trade at that time. Now, when it came down again, the setup got activated and you entered again in a specific trade. Now because you have already made some profit, so now you're confident enough to put more capital. You put more capital here and you made again a 20% return. Now that is around 40,000 rupees of profit. Same thing you do again. Let's say you put 30,000 rupees, you made 10% return in 90 days. You can see here. So that is around 30,000 rupees. Now this same exact momentum you captured in terms of investing. And when you did that, you made 47% returns. And that was a total of 47,000 rupees in profits. But here the percentage return will definitely vary, but the total profits that you made here was 92,000 rupees of profit. Definitely loss can also take place, and that we will talk about in the later part of this video. But here I am telling you the difference between the swing trading, how the swing trader approaches the market, and why he approaches the market in that manner. And if you like this type of trading, you can definitely go or jump into it. Now if someone is having a lot of capital, they should go for investing. The most important thing is the number of trades will keep on increasing as you go from investing towards swing trading towards day trading. That's the major difference. Okay, so now we will move to a more deeper concept that is known as how the market moves. Market moves due to the supply, which are known as sellers, and demand, which are known as cluster of buyers. So a lot of people who are buying in the market takes them to the top, and a lot of people who are selling the market takes it again to the correction phase, which we call, or a downside. Now the demand of that price or the instrument is high, so more number of buyers will be generated at that area. You need to choose which one you will be. Will you be a buyer of your trade? Will you be a seller of your trade? You can make profit from both of them. Let's say that this is the zone that I'm talking about. This is the supply seller's home. Sellers dominate this zone by pushing the prices towards the downside like this. Okay, so number of sellers are more, so they have overpowered the buyers, as I just told you, and the similar goes for the demand. The price eventually moves up because in the long game the buyers have dominated that particular zone, lifting the price higher, again overpowering the sellers. So that is how the price chart will look like. Let's talk about tools, which tools you will be using first of all, and then we will go into the charting. So the charting is done on the TradingView platform. I will show you guys how to approach the TradingView platform. Now if you have watched till this point, definitely like this video. Next video that I'm going to be making is on TradingView platform, the complete guide, and this will be very different from what you have seen till now. In order to do that, you need to subscribe to this channel as well. These are the three things in order to become in order to start trading and executing things. Yes, you heard me right. Charting, at which platform you are doing your charting, which broker you are using. I personally use Zerodha. This is not a recommendation to you guys that use Zerodha. You can choose your own broker. Okay, but I personally feel that I'm comfortable with it. That's why I use it. And then we have a journal. I will get to that point. So these are the three important tools. Guys, we are going to enter the charts on TradingView platform. So before that, let me give you very small idea of what we are going to learn in this video now. So we will be understanding candles. Okay, not in detail. I will make a different video on candlestick, but here you're going to understand a glimpse of what candles are. Okay, so a candle consists of these four things: open, high, low, and close. That is what we call OHLC. So whenever you say whenever you meet a trader who is saying OHLC, that means this. He's talking about a candle's open, high, low, or a close. Okay, there are time frames in trading. Now this is the most important part of any trading, because here it justifies which type of trader you are. If you are using this 1M, 3M, 5M, what is this M? Till this point it's minutes. This H is hours, and this is daily, weekly, and monthly time frame. So if you ask me which you are using, I use daily, weekly, and monthly time frame because I'm a swing trader slash a positional trader. I hold my trades for a longer period of time, putting small capital, medium capital to sometime big capital. Okay, it depends completely on the type of setup that I'm trading. You will also understand about setup in this video later on. Trader, intraday trader type of person is going to be using 1 minute, 3 minute, 5, 15, 30 minute, 40 minute, and at max maybe 1 hour. Okay, sometimes they also use bigger time frames, and then they analyze things on the bigger time frame, use the smaller time frames. So there are some tips before we go to the charts. Some tips to start is, if you make any mistake in trading, that is actually good. Make sure you do them fast. Okay, if you are making any mistake in trading, it should not be considered as a bad thing. It's a good thing actually, because mistakes, if you have made, let's say 10 mistakes, now you should write them in your journal, in a diary, and then you should not make at least those mistakes in order to improve yourself. And why I've written fast? Because you need to be very specific with your trading, guys. You need to apply everything really fast, because the faster you lose more amount of money, the more you will get to understand about your own psychology and what type of trading you fit into. Okay, because every trader fits into a particular type of trading. The second one is, if you don't always think if you have made money in trading, that does not equate directly to a good trade. A good trade means that you had a setup, and then that setup has been executed and you made money out of it, or maybe you lost some money out of it. If you lost some money, then it's a mistake and you note down it. Don't repeat that mistake. So the simple formula is, a good setup equals to possibility is high chances of making money, but The reverse of this is not true, which is if you made money, that does not mean it is a good setup, it was a good setup, or it was a good trade. Always remember this. Let's talk about the concepts of brothers and sister terms. So this will be like a brother and sister term. Like all these terms means the same thing. Okay, they are relatives to each other. Okay, but yet we define them in a different manner. Okay, so let me put it this way. So whenever someone says that they are going to buy something, or they are going to go long on that instrument, that means that their setup is triggering a upside movement, so they are playing for the upside. Similarly, if they are saying that they are going short or selling in a stock or an instrument, that means they are focusing on the downside, their setup is triggering for the downside. That's the trade logic. Now, what do I mean by bullish and bearish are also terms. This tells the sentiment, basically, that is it a bearish sentiment or a bullish sentiment. So that's the sentiment thing. Demand and supply, now you know, a cluster of all those buyers, demand, a cluster of all those sellers that are pushing the price to the downside, supply. Uptrend and downtrend. Uptrend means that, now this is a new word for you guys. You can write it, that this is the trend logic. And that means the market structure. Market structure means, let me show you that. For example, here if you see, let's go to the line chart. Here the market structure is saying, I'm just going to ask you guys one simple question. From this point till this point till the top, where did the overall market went? It went to the upside, right? So the market is in a uptrend in this particular area. Similarly, if the market is falling after that, it's in a downtrend, right? So market structure is telling you that it is in a downtrend. Now you have to open tradingview.com. You just have to go to your browser and type TradingView there. Thing that pops up, TradingView. Go to the products and super charts, and there you are. You will have charts right in front of you. Now I am opening this one. For example, let's say that you are on the line chart. So the moment you open your TradingView platforms, you will have candlestick chart here, line chart, and there will be many more charts that are here. Okay, so which one you have to follow? You have to follow the line charts and you have to follow the candlestick charts. Okay, so you can switch between the charts in this manner, from line to the candlestick chart. Now what exactly is a candlestick? Candlestick helps us to create a perspective, deeper perspective about the price, creating some movement. Now I'm again and again saying this, price creating a movement. Let's give it a name. That name is price action. That's what most of the traders use in their day-to-day language. Price action, that if the price is moving up and then rejecting, sellers are active, then it falls down, and then buyers are active at some area. So this whole in combination is known as price action, price movement. Let's talk about the candlestick. Let's say that this is a green candlestick and this is a red candlestick pattern right here. You will see only two of these. You can change the color as per your understanding and thought process, but most of them will look something like this. It will be a candle, just like a normal candle you guys see around you. Okay, there is a wick. Okay, and then there is a wick on the upside and the downside. Now what is the overall perspective of this? If it is a green candle, it shows you that this is the opening price okay, and this is the closing price. So whenever you see a candlestick in green formation, it would be in the manner of opening O, closing C. Again the same thing is coming into the picture, OHLC. So that's the opening, that's the closing of any stock or instrument or any crypto, forex, anything you are trading, swing trading on. That's the go-to thing, right? Opening, and the price went up and it closed here. So that's how you do it. Now what do the wicks represent? The wicks represent something else. The wick represent that the price did went to that area on the charts, but closed at this area. Okay, I will show you the example in this manner also. So that's the high created by the market, H, and that's the low created by the market in this situation, L. So that is OHLC for you guys in the green candle. Similarly on the red candle, it would be, you guys can pause the video and think at yourself that this is the opening. Why? Because if something is going down, it would be red in color. Something is going up, it would be green in color. That's the concept here, nothing more. That if it starts from here, closed at this area, so it's going up, so it's green. And if it is falling, so it's red. Okay, it's falling, it's going down, so it's red. That means it started its momentum from this point, so that's why this will be the opening for you. This will be the closing for you, and again the same thing, that would be the high and that would be the low, because highs and lows are common for all the charting that you're going to do, but opening and closing depends completely upon the candlestick that you're going to see. Okay, now for example, if you see this candle right here on our Nifty 50 chart, then you will see there is this opening, and you will see that there is no wick here. So what does this represent? This means that the opening here is equal to the high of the market. So O equals to H at this particular point. Whatever the opening was, that is also equal to the high of the stock or the instrument that you're trading on. And then it is red in color. That means the whole day, because right now we are on a daily time frame. So it is representing every single candle is representing a single day, the trading done on that single day, one day. So here opening equals to high. So what is the closing of this stock? That's the closing of the stock, and that is what we call C again. And right here, this wick is the lowest point created by the candle. So if I'm just right here, so that's your OHLC for this particular one single candle, and it is representing a huge movement, a volatility, lots of sellers are there, a strong supply zone is created there, and there is a fall, you know about the OHLC now, and that's a daily time frame we are talking about. So this much is clear, I guess. Now let's jump to one level up, and that would be the time frames. Okay, so let me open two Nifty charts here. Okay, one is representing the weekly time frame chart here, and one is representing the daily time frame chart here. So that's the weekly time frame chart, the daily time frame chart, you guys can see. Okay, so if you see, that's the area I'm going to mark as 24954, and that will be 24954 exactly. So you guys can see this was Monday right here, this was Tuesday. Let me mark it. So this candle right here is the Monday candle, and this candle right here is the Friday candle. Okay, and this one candle represents its own OHLC value for that particular day. Then this candle represents its own OHLC value for that particular day. Okay, this is green because buyers were active on that day, and its opening is this price and closing will be that price. Similarly, if you go to the weekly time frame, you will see that how the price opened at this particular area. That's the opening, right? You guys can see this is the opening of the week, because whatsoever, and this is a really cool thing, guys. Why? Because whatever the opening is of the week, that will take place on Monday, right? If there is no holiday, if there is holiday, it will be Tuesday or subsequent days, something like that. But if it is a Monday, then definitely that's the opening, and it closed here, right? And that's the closing right here. You can mark the closing also. So that's the closing of the week. Now you don't have to mark that this was the opening, that was the closing, that was the high, that was the low. That would be very tricky for you, right? So for that, we have multi-time frame so that you can ease out your work here. And if you see, that's the high, that's the low, that's the opening of the week, that's the closing of the week. You have your OHLC for the whole week, all the levels marked right there, so that you can ease out on this. So this is how you use the multi-time frames: daily, weekly, and monthly. You do the same thing on a smaller time frame, you do the same thing on a bigger time frame than this, like monthly, or a smaller time frame than this, that is a 4-hour time frame or anything that goes below. Now we will focus on the risk reward ratio. So right here you guys can see that this is the place where you need to come and then click on a long position or a short position. That's the projection area, right? I will make a whole detailed video on TradingView platform, how to use it, how to use them in a better manner. Okay, just go with the flow right now. So this is the long tool I'm putting. Open the long tool and keep it here. It will look like this. You might have seen it on some shorts, reels that you are seeing, or maybe you are a trader and you know everything about it, but still let's go to the details of it. Now, when you put this tool, what is the meaning of this tool? The meaning is that you are putting it at the place where you have bought something. You have bought something at this area. Okay, that's your trade entry basically. Okay, and where you are exiting, you are marking that as well. So that is where you are exiting the trade. So that's your exit that you are marking right now. And where you are exiting the trade, if the trade goes against you, that also you are marking here. Okay, so that's your exit again right here. Now we have two exits, so let's name them, right? So because we cannot just name both of them as exits and exits, so we should name them. So this is what we call that. Let's say that you have taken a buy position, that you have taken a long position. Okay, now whenever you take a long position in the markets, so that means that you are focused very much towards the price to move from this place to the top side, right? Now for that to happen, the price will go in that manner only. As I told you in the starting, the supply and demand theory, the price action will take place here. Okay, so whatever the price action takes place, let's say that you took the entry exactly at this spot, and as your exit hits, that is what we call the target is hit. So that's what we call take profit. Okay, so we have named it something TP, take profit. So TP is known as your take profit. You take your profit from that area, and that's your exit in this particular situation. Similarly, if let's say that the price does not go up, rather it goes to the downside, the sellers were active, you were wrong about your trade and you lost in this trade. Okay, definitely you will learn something out of that loss. That's the psychological part. But the in terms of charting, this is what we call making an exit at the wrong side. So when you are wrong about your trade, that's what we call a stop loss, because you will be losing money. You need to stop that loss, that now I have taken enough, let's stop it right there. Okay, so that's your stop loss theory. Now that's the trade entry, trade your take profit and stop loss. Now let's talk about the risk reward ratios. So guys, in this trade, let's say that you are taking a certain amount of risk and you are taking a certain amount of reward. So just like I told you, take profit, so this is the reward and this is the risk in the trade that you are taking. Okay, similarly you will name these as your ratios. Why? Because let's say that you are giving 3.27% as your take profit, right here it's written, and similarly 3.27% as your stop loss. In this situation, your risk reward ratio gets out to be 1:1. Okay, 1:1. Better risk reward ratio, that could be 1.5:1, or 2:1, or 3:1. Okay, what do I mean by that? I mean that let's take it to the, and see guys, the risk reward ratio, it will be written in at the bottom, at the center of your entry. Wherever you're taking your entry, it's written right there. So if it is 1, that means 1:1. Now let's take it to the upper side and let's take it to 6%, because it was 3%, right? Now it is 6.5% as your take profit. So your reward has increased in this particular trade. You're keeping a bigger reward. That's your take profit. That's your exit for this particular new trade that you are taking. Let's say that you hit your target. So what you will say, you have made a overall of how much percentage return? 6.5% return in this trade, and you are playing a trade of 2:1 in order to get to that target. Now let's focus on the win rate risk reward ratio table. Now what is this? This means that how good you are doing in terms of your psychology, your setup and everything. We'll get to the strategy part just after this, but before that, this is important to tell, because risk reward ratio and the win rate tells you about where you stand in trading. As a full-time swing trader in Indian stock markets, I can only go long, so I'm telling you that knowledge. So let's just go to the long position and mark it like this. Now let's say that I am planning for a 1:1 risk reward ratio. Now you guys know that when I keep this at 1, that means 1:1. When I keep this at 2, that means 2:1 risk reward ratio. And when I keep this at 3, 4, 5 subsequent numbers, that means 4:1, 5:1 risk reward ratio. That means I'm getting more and I'm risking less. I'm risking 10 rupees and getting 10 rupees, that is 1:1. Risking 10 rupees, getting 20, 30, 40, 50 rupees in a trade. That means 2:1, 3:1, 4:1. Let's say that I'm taking 10 trades in total. Okay. And out of those 10 trades, if you see, I am making, let's say, profit in only two of the trades. Only two of the trades I'm making profit, and rest of the 8 of the trades I'm not making any profit. I'm actually losing in those trades. What exactly can I tell you from that? So that means my win rate is coming out to be 2 out of my 10 trades, right? So win rate is equal to 20% in this case. That's where your 20% is. I will give you one example, you will understand the whole chart. If I was giving market 10 rupees and I was getting 10 rupees from the market, that means risk reward ratio is 1:1. So when I say 20% and this tile right here, this tile is telling you that overall you will be in loss. Why? Because you are playing a 1:1 game, right? That means you're winning 2 times and you're getting how much? 20 rupees. You're losing 80% times, which is equivalent to 8 trades, which is equivalent to 80 rupees of loss. Plus 20 and minus 80. So overall you got at minus 60. That's why you were on loss. Now the same thing with the 30. You're making 3 good trades, means you are at a 30 profit, but still in the in 70 trades you are losing, right? Still at loss. And what is this break even? Break even means that when you are focusing on a 50% win rate, that means out of 10 trades you are winning in 5 trades, and you are playing a 1:1 risk reward ratio. That means plus 50 and minus 50. That means you are neither winning in this one, neither losing anything. So that's what we call break even, 0. Now when you are going to win, actually that means 60% win rate should be at minimum if you need to win with a 1:1 risk reward strategy. Now with that, I'm also opening the Pandora box of strategy. I'll get to that. Okay, so here if you see 60% win rate means you're making plus 60 and you are giving how much? Minus 40. That means finally you are at a profit of how much? Plus 20, right? Because it's a 1:1 risk reward. Now let's increase this risk reward ratio to 1:2, like just like that. Now, which means that you are giving market 10 rupees, but you are getting 20 rupees from the market, right? Now in this situation, if I see where is the win rate, it's 40%. 40% win rate means 4 winning trades and 6 losing trades. That means I'm winning less and I'm losing more, right? But this 6 trades that in which I've lost, right? So let's multiply that with how much? 1, because I'm just losing 1 and I'm making 2, right? So 6 into 1, that is 6. That is equivalent to 60, right? In our case. So I'm losing 60 rupees out of 10 trades. But when I'm saying that 40% win rate of 1:2, that means every trade I'm making 20 rupees. That means if I'm winning in 4 trades, 4 into 20, that will be 80 rupees. So I'm losing 60, gaining 80. That means an overall of 20 plus. Similarly, so that's how you read this particular chart basically. Okay, so you guys can see in which cases, basically what is the summary of this, in which cases you can make the maximum wins. How can you be more profitable? Because in the starting, as I told you, it's all a game of consistent profitability and nothing else. You need to focus how you will be consistently profitable, right? And this tool right here, this chart, will help you do that. Now we come to the most important part, that is building a strategy, building a business plan, executing it on the basis of back-tested results, and creating a journal out of it, finally getting into the trading. So right here, if you see that how to identify a trend, it could be a uptrend or downtrend. See, trend is everything, because trend should be your friend. That's what it is said in the trading community, and we always follow it. I'm going to be giving you guys some tools here. The first tool that I'm going to be using is the trend line tool. You can just come to this place and use the trend line tool like this. You can make a trend line in this manner. Okay, I will show you guys how. The next tool that I will be using would be the Fibonacci retracement tool. Let's say a Fibonacci retracement, a Fibonacci tool like that. Okay, now a combination of both of them will give us a strategy. Now I'm not saying this is the strategy that I follow a strategy which contains 8 to 9 ingredients combined. And what exactly is this ingredient? It's like these two things. So these are two ingredients, just like that. I use 8 ingredients for my strategy. Here I'm just giving you example, so take it that way. Now let's say that what is an uptrend and what is a downtrend, how to identify it. It's not exactly, see, I told you guys that this was a uptrend and then this is a downtrend. No, it's not that simple. That is for your understanding, so that you relate at the back of your mind that if something is again and again moving up, that is a uptrend. Moving down, it's a downtrend, right? But how to identify in terms of a line making or a chart making here? This line is being taken multiple times support at this area, just like the demand. I told you guys multiple buyers are activated there. Similarly, this is a trend line that I've created and multiple buyers are activated on this particular trend line. Okay, now I just need 2 points here and I will get the third point automatically in that manner. So here the information that I'm getting is that whenever the market comes to this trend line, the buyers are activated. So whenever it will come to this trend line, the buyers will be activated. As simple as that. Now if you have that piece of information at the back of your mind, you now can apply this information in a certain manner. But that is not a strategy. This is a simple one ingredient. Until you don't have 2, 3, 4 confirmations, that's not a strategy right there. Okay, so I will also use some candlestick. I will use the trend line. I will use some logic, risk reward tool, and Fibonacci, everything here. Now, for example, now guys, one very important thing, until this particular line is not been breached, we will say that the market is in a uptrend. That means it's in a uptrend. It will only move up. The moment you will see a breakdown of this line, for example like this, and now it is moving on the downside, the line is being broken, the trend line is being broken, so uptrend is broken. Now we will see the downtrend. That's how you should approach towards this particular thought process. But as a swing trader in Indian stock market, okay, I am not a fan of downtrend, because then I'm not going to get a lot of trades there, right? So I'm a fan of uptrend. I'm a bull overall. Now going to this place, if you see that so now here somewhere around this area is, now I've marked these 2 points. I've extended the line for the future. Let's say that the price comes to this particular area. Now I'm going to be showing you the Fibonacci tool. Let's put the Fibonacci, and let's say that this was the trend, that this is where the trend started and the trend is going like this, and that's where the trend ended, and then the price is somewhere around this area. Okay, now let's make a Fibonacci from the bottom and till the top of the trend. So from where the trend actually started, you can see that visually from your eyes, right? And then you can see from where the trend is reversing itself. Now it should be moving even higher. It's not, it's moving downwards. There is some supply. Visibly any demand that you're seeing and visibly any supply that you are watching, that's basically your 2 points that you need for your Fibonacci to work. Now I personally sometimes use Fibonacci, and if I tell you guys that this is the most important zone of a Fibonacci for any trader, even if you do day trading, intraday trading, or any type of swing trading, long-term trading, 50% to 60, 0.6 and 0.5 levels are the most important ones. These are also known as, this is also known as the golden ratio level. Always try to catch the trend when the trend is reversing a bit. Okay, so let's say that the trend is reversing from here and now it is coming down. Is the trend line that you're using, it's broken or not? If the trend line is broken in the first place, let's say that this is the case example, that it was moving up and down and up and down, and then it was in this manner. Now if it breaks for the downside, then you don't have to use the Fibonacci. Let it break. We will see what we can do in the future. But if it is not breaking, rather it is taking support like this, a demand at that area, then what you need to do, open your Fibonacci first of all. See from where the trend started, see from where the trend is reversing. Okay, put it at those areas and see if the stock comes around this area of 0.5 to 0.6. That's where I'm going to take part in the entries. And how I will enter, I will show you that. Now that is where the entries are being made. So that's like a strategy that I'm creating here first, for you guys firsthand. And this is like a very, this is a very not, this is not a very normal strategy. It still is a bit advanced, although if you understand trading a little bit, this is very simple. So I've created a trend line, okay, and that's where the trend started. If you see the new uptrend, and that's where the trend reversal came, right? So you can always mark these points with a horizontal tool right here, this tool, horizontal tool, and come to this area, this, that's where the trend is again reversing to the upside, again reversing to the downside. So that's the area you need to focus on, and that's your trend. Now if this trend line is being broken to the downside, the trend is over, the uptrend is over, now you will focus on the downtrends. That means you will sell, you will short. But right now I'm seeing that the market is moving on the upside only, so I will focus myself on the upside only, right? I will not go against the trend. Now that's my area. Now I'm going to put the Fibonacci from this third part, come to Fibonacci retracement, that's the bottom, and that is the top. Now I will just extend it till this particular area, and you will see how beautifully the market has taken support from the 0.5 to the 0.6 area. So that's my area. I'm going to mark that area first of all, and now I'm going to click on the Fibonacci and remove it. And remember at the back of my mind that this is the area where the price turns. If the price is moving up and up and up, let it retrace back, come to this area. Many people will think to sell at this area, but you are thinking opposite. You're going to go long at this area. That is what will create a strategy that most of the people are not following, but a very limited amount of people are following, but they have the most amount of money, thus they are winning in the markets again and again. Now that is where the strategy part comes into the picture. So I've created a Fibonacci retracement here. Okay, so that is what we call Fibonacci retracement. Why retracement? Because the trend is upside and the trend is retracing a bit. We are not saying it's completely reversing, we are just saying it's retracing, and it will continue to the upside. That's our whole focus here. So that's the box we have created, and there is a trend line. So what could be the possible positions we can create here? Just like that, that's the possible position. Now let's say that we create a position at this area. So will you keep this much big risk in this trade? Okay, will you wait? Let's say that you entered at this area, because that's exactly where the trend line support is, and the 50-60% Fibonacci retracement is also coming out to be. Now in that situation, let's say that the market goes down to this point, you will exit at that area? No, logically if you see, even if the market comes to this area right here, below this candle right here, that's the OHLC of this daily time frame candle, and you have entered at the closing of this daily time frame candle. Got it? So you will keep a stop loss below the lowest point, the L of that candle, right? Or the areas of the cluster of the candle, or you can just say a demand zone of that area. So below the demand, you're keeping a stop loss. That's where you need to stop your loss. That's where you need to shut down your trade, right? Because you can go to further losses if you do not, right? Now here, if you go with a 1:1 risk reward ratio, now revise the chart. If you go with the 1:1 risk reward ratio, what will be your win rate in this particular trade? You need to write down. Now coming to the very beautiful part of this whole video. Now coming to the beautiful part of this video, guys, you can see I have trading journals. I have a lot of trading journals. These are just two of them. I have plenty of them. I have to, and I keep reading them again and again. What are in these journals? See, I am not a fan of writing everything on Excel files or anything. I'm a fan of writing it manually because I love it personally. That's completely on you, that how you will approach this. So journaling is like that. Let's see that I took a trade here, okay, on this is Thursday. Okay, let's say what happens on this day. The market goes to this side and it hits the stop loss. Now I will open my journal, start writing that the market opened here. This is the OHLC on that day. The weekly time frame, I went to weekly time frame, it was also showing some signs of bearishness or the downside, but I still took the trade to the upside and something like that. So you will start writing something, what's happening in the market, what are the time frames saying, what are the candles saying, what is the strategy that you are working on, and what is the win rate here that you're focusing on. Now let's say that you have a that you know that either you should be having a higher risk reward ratio or higher win rate. But how you would know that this strategy would be having a higher win rate or a bigger risk reward ratio? As I told you in the starting, that you need to be losing fast in the markets in order to learn more and more from the markets. Because see, if you take a lot of time to take trades, like I took a trade today and then after 10 days, 20 days, 30 days, or you are taking 30 trades today and you are not able to understand anything, no point. It should be systematically that I've kept a stop, I've kept a TP. Okay, let's see what happens. Let's see. And you, after 10 trades, you will get the knack of it basically. And after 50 trades, 100 trades, you have written in your journal like this, exactly like this. For example, if the same thing happens maybe in the past, you can just make again let's say at this area you can again make a line like this. Okay, again I'm going to throw a Fibonacci from this point to this point. I am seeing the similar thing is happening at this area as well, that is the 50 to 60%, right? And then I'm taking the entry here, the price is again moving up. Okay, so that's just like a quick thing that you can do, a back testing thing. And now I'm doing this on a daily time frame, so write D at the top and then start writing all these points at the bottom. Similarly, start doing this at this area. Now for example, I'm having this 1:1 risk reward ratio. Okay, let's see till which point this stock is moving. It's moving till 1:3, right? It's moving till 3:1 risk reward ratio or something like that. So you need to figure out exactly how the risk reward ratio game is playing out for you, how many times you're failing in this strategy. That is what we call back testing. So I just told you how to do strategy making, back testing, and journaling at the same time. Now if you do this same thing with multiple things, it could, see, trading is a very big word. I cannot just put everything in one video. So this might just be a start for you. After the strategy has been created, you need a broker to place the order. Now I'm not recommending anything here, I personally use Zerodha. Okay, so let's say that this is the chart of Reliance. For the sake of example, I'm just saying that, and I want to enter this I want to enter the swing trade of Reliance at this area, right? Let's just imagine, let's say that this is not a Nifty 50 chart, it's a Reliance chart. Okay, for example, and I want to put my trade exactly at this area. Go to my broker, all the brokers look similar. Now in the search area, I will select the instrument that I'm trading. So I will click, I will write Reliance, whatsoever I'm trading there, whichever the chart I analyzed, I put my strategy on. First of all, you need to do a lot of back testing. When you come up with the result, then you need to apply all these things on your own. Okay, so let's say that I'm on that stage where I'm seeing the chart of Reliance on TradingView platform, and now I'm going to the broker. At the broker platform, I will see B, S, and there will be many more things written here. Okay, and I'm at the position tab right here. In the position tab, the moment you take a buy or sell position, it will showcase everything there. Now let's say that I click on the buy button first of all. Okay, I come to this particular area, and right here I can click this symbol and switch my quantity to the amount. Okay, so I want to go with, let's say, 10,000 rupees. So 10,000. Okay, now in 10,000, if I'm writing 10,000, the margin required definitely would be 10,000 because it's a swing trade. So at what price it's asking. So if I just click on the cross button, it will give me at the market price. So wherever the market is trading, it will hit exactly at that area. Okay, now if it is a market price, that means whatever the price the stock is trading or the instrument is trading, I will be given that exact price. So I can also mark that and just leave that trade. Now let's say that I want to go with the market price and I'm putting 10,000 rupees. All I need to do is just click this buy button. Now currently, if you see, buy Reliance will be sent to the exchange at the next market opening. Okay, so right now the markets are not open. Okay, markets have closed. So when the markets open, they will be this is a scheduled order for me now. Okay, now this is the scheduled order. Okay, I can just come to this part and just cancel this order right here. The order is cancelled. Okay, now if you are trading in the real markets, this order will be executed right then and there. Okay, order will be executed right in front of you. Say that you got this 10,000 rupees, so it will come to the position side again, orders, positions. Now you are getting some idea about Now you're getting some idea, right? So when you go to the positions tab back again, you will see that it will show that you have bought rupees 10,000 of Reliance at this area. Now this is strategy. For example, let's say that the strategy that you have created, back tested, journaled everything, now is the day that you're going in with it. Let's say it has a 60% win rate and you are planning to go with a 1:3 risk reward ratio in this particular trade. Okay, beautiful. Okay, so now you see from how from literally zero scratch you are now gearing up slowly and steadily. Okay, so you're now putting 10,000 rupees into this trade. Your mindset is 1:3 risk reward. That means 1:3 risk reward ratio means that if I'm going to give market 10 rupees, I'm going to get 30 rupees out of the market. Okay, and what is the win rate that is coming out? It's 60%, let's say, for example. Okay, now there are high chances that you will win in this trade, high probability, right? Now you're risking 2% in this particular trade, right? So what is the 2% of 10,000 rupees? It's 200 rupees, right? So if the trade goes to this area, you will lose 200, and it will come at this point. It will be a position here and it will show minus 200 for you. You will click on it and exit the trade. Okay, as simple as that. Now if the trade in this case, let's say it moved up slowly and steadily and it hits this target right here of yours, you kept the target 1:3, right? So it is giving you how much? It is giving you 7% at this point. So you're gaining plus 700 at this point, right? So at the end you can finally see 700 profit plus 700 on your screen, on your trading terminal right there. You click on it, exit the trade. So guys, that's it. So yes, that's pretty much it. I hope you will subscribe to this channel, and if you want to contact me, my Telegram link is given in the description box and comment section pinned. You can directly contact me there. Thanks a lot. We'll see you in the next learning video.